Here's what your CPA probably isn't telling you. With the right strategy, you can be deducting your meals, your travel, even part of your house legally. This isn't tax evasion, and it's not a tax loophole. It's tax education. Most people spend after-tax money and wonder why they can't get ahead. I mean, think about it. They're paying taxes, and then they're spending money and they're going, why don't I have anything left over? It's taxes. The wealthy don't do it that way. They spend their money before tax, not after tax, because they understand this one simple truth. If you want to change your tax, you have to change your facts. The tax law is based on your facts and circumstances. And if you do things the way the government wants you to do them, then you end up with a lower tax bill. So in this video, I'm going to show you exactly how to take things you already spend money on. This is not new things you're spending money on, but things you already spend money on, and make them legally deductible. Sound too good to be true? Well, we're not talking about gimmicks here. These aren't tricks. These are just strategies that the IRS condones. They're not saying don't do this. They're actually saying, here's how do you do this if you want to do this. If you're willing to take the effort to change your facts, we're willing to lower your tax. It's already in the tax law. Let's start with how the average taxpayer spends money. You earn income, you pay your taxes, and then what's left over is available for you to pay your expenses. Now, the wealthy, what I call super taxpayers, they do it very differently. They take what they earn, they take that money, then they spend the money, and they pay taxes on what's left over. Now, why is this important? Okay, so let's go through a very simple example here. Let's say you earn $100 and you have a 20% tax rate. Now, most people, if you're watching this, you've got at least a 20% tax rate. So you earn $100, you pay 20% tax, and then you have, or $20 in tax, then you have $80 left over to pay for expenses. What if you did it the way the super taxpayer did it? Then here's what would happen. You'd take $100, you'd spend the $20, then you'd be taxed on $80. So 20% of $80 is only $16. Get it? So instead of paying $20 in tax, you're only paying $16 in tax. Now, add a couple of zeros to that. Maybe let's start with just 2 zeros. Okay, instead of $4 you're saving, it's $400 you're saving, or more than that. So it's really significant savings when you start adding up every single thing you spend money on every single day. This is one of the keys for why the wealthy pay less tax than you do. And by doing things the way the government wants them to do, then they get to deduct their expenses before they pay tax. Now, if you have enough expenses, that means you can pay zero tax, right? That's exactly right. So I'm going to show you, I'm going to walk you through in this video exactly how to do this. So let's start with your home. Okay, so you've got a side hustle and you're doing some work there in probably a corner of your house, or you maybe got a room set aside to do a little your side business or your real estate investing, whatever. And you go, well, wait a minute, I'm doing this to make money. So if I'm doing something to make money, shouldn't there be a way to deduct what the expenses are in order to make money? So you've set aside a portion of your house to make money. So what the government says is, well, if it's exclusive, okay, you have to regularly use it, just not casually, but regular and exclusive just for a business or your professional investing, like real estate, for example, then you get to deduct a portion of everything in that house. Okay, so as an example, let's say that you have a cleaning person, or even better yet, everybody has utilities. And by the way, it doesn't matter whether you own your home or you rent an apartment, it's a portion of your expenses. So if your office is 10% of your home, then that means 10% of your home expenses really become deductible. That means 10% of your utilities. That means 10% of your internet. That means 10% of your weekly cleaning. It adds up. It's these little things that add up every day. So don't believe somebody who says, well, don't take a home office deduction because it's not worth it. It's not worth the trouble. I will tell you, I know of taxpayers that save thousands and thousands of dollars in taxes simply with the home office. So that's just one. What about your car? Well, I'm going to give you 2 little tips on your car. First of all, if you use your car to go meet a client, to go look for a property, for a business or investing purpose, a portion of that car is deductible. Now, IRS gives us two different ways to do it. One is we can just take a mileage rate. Now, the mileage rate is up over 70 cents a mile now. 70 cents for every mile you travel. Well, that means if you travel 100 miles, right, that's $70 of a deduction. You go, well, that's not very much, but that might be 100 miles in a day. What if you multiply that over weeks? Now, let's add this to the home office. Now, normally, the first trip you take every day is a commute, and the IRS considers that a personal expense. The last trip, when you're coming home, also is a commute. Let's say you have that home office, and you go to your home office in the morning. That's your commute, the 30 feet from your kitchen to your home office. And then from there, you go to see your first client. Then when you come home, you don't come home to your kitchen, you come home to your home office. All right, you're coming home to your home office. That last trip is also business use, so that's also deductible. And then it's the 30-foot trip to your kitchen from your home office that's your commute. See, so it's not just that you can take a deduction, it's that you can maximize your deduction. Don't forget, the wealthy are always maximizing their deductions. Next, what about meals? So a lot of people think, well, I'm going to lunch, I have to eat, therefore it's not deductible. And the reality is, the way the IRS looks at it is, that's true. Your portion of the meal isn't deductible. But let's say you pay for somebody else. All right, now is their portion of the meal deductible? And in fact, the IRS has made it simple. It's not, you don't have to separate it out between their portion and your portion. You just divide the bill in half. It's kind of like when you take somebody you go to dinner with somebody and you say, hey, let's split the bill. And, they had lobster and they had 3 different alcoholic beverages, and you had a soda and a sandwich, and you're splitting the bill in half. It's kind of the way it works also in the IRS, but in many cases, it's going to work in your favor. So it's just 50%, right? You get to take 50% of business meals. Now, what's a business meal? Now, a business meal is you have to have a discussion that's truly business related and truly business important, either before, during, or after the meal with that person that you're paying for, okay? And it's only meals, by the way. It's not entertainment. If you take somebody to a baseball game's not deductible, but the hot dog and the beer that you get at the baseball game, that is deductible, so long as you've discussed business before, during, or after the meal. Now, of course, you have to document it. I always say that if you pretend to document a business deduction, you get a pretend deduction. The IRS, first thing they're going to look at if they audit you is they're going to look at, did you document it? So what do you have to document? Well, it's really who, what, when, where, and why, right? Well, the where and the how much is that's all included on the receipt. So you're going to keep the receipt. Now, I suggest you actually scan the receipt, because if you hold on to the paper, it will eventually fade. And by the time the IRS comes around, it may be a blank piece of paper. So scan that receipt. Okay, the IRS will accept scanned copies. Then, right before you scan it, just write on it. Who are you with? What did you discuss? And what was the purpose of the discussion? Okay, so the when is already on the receipt, right? They usually have a time and date stamp on the receipt. And so that's already there. You just need to put, okay, we discussed this. Here's the business purpose. Now, let's say that once a week, you and your spouse go out for dinner. Well, if you're a business owner, my guess is every single week you're discussing business. I have never met a business owner that didn't discuss business with their spouse. When they take their spouse out to dinner, at least once a week, you're going to discuss business. I find that I've always found that that's very useful. Now, my first wife, who passed away a few years ago, she was a musician. She didn't know anything about business. She didn't want to know anything about business. She was a really good sounding board. And I actually found it really useful to talk to her about business and kind of run things by her. And that's why it's deductible, because it really is an expense that will help you increase your profitability of your side business, your investments, your full-time business, whatever that business is. Just remember, you don't get that if you're an employee. You have to have a business. What about your cell phone? Now, this is an interesting one. I'll bet you didn't know this. If your business provides you with a cell phone, you get a different deduction than if you use your personal cell phone for business. See, if you use your personal cell phone for business, then the business portion, you can submit an expense report to your business and get paid back. And you effectively get to deduct that because the business is deducting that and you're not picking up an income. But what if the business provides your cell phone? Well, now it's not taxable at all. In fact, the business gets a deduction as long as the primary purpose is, hey, we need you to have a cell phone, right? Which most businesses do require that. We need you to have a cell phone, so we're going to provide you the cell phone. Well, what if it's your business? So your business buys your cell phone, pays for your cell phone expenses. The IRS says, well, the personal portion, that's a de minimis fringe benefit. We're not going to make you keep track of that. So if the business buys that, again, we are maximizing our deduction. We're not just changing our personal, might otherwise be a personal expense, our cell phone, to a business expense by using it for business purposes. We're actually changing it from a portion of being deductible to the entire thing being deductible simply by who buys the cell phone and who pays for the cell phone expense, the monthly expense. So that's an easy one. And if you're not doing that, here's my gift to you. Next, what about education? So education is an interesting one. The IRS says that seminars are not deductible. However, there's a caveat, and that is continuing education is deductible. So let's say that you have an online business. This is your side hustle, and you go to a real estate seminar. Is that deductible? Well, it's not really continuing education, is it, for your side business? Unless at that real estate seminar, they're talking about general economics. They're talking about what's going on in the economy. They might be talking about what's going on in the tax law. I speak at a lot of those seminars. Well, then it might actually be continuing education for your business. Now you're going to have to prove that. On the other hand, if you had a real estate business, you are a true professional real estate investor, and you go to a seminar for real estate, continuing education, absolutely. So here's another way that you enhance your deductibility. I hate seeing on a tax return at a seminar or seminars as an expense. Rather, what I want to see is continuing education. If I put seminar down, I guarantee you the IRS is going to challenge that on an audit. If I put continuing education down, they may or may not challenge it. But the reality is that as long as it's there to enhance your current business, not a new business, that would be a startup cost, but you're a new business, then that's deductible. Again, as long as you document the who, what, when, where, and why. Now, what about travel? Travel's a big one. Travel is an interesting one because you really have to make a choice. Kind of like with the meals, you have to choose, do I really want to talk about business tonight? Honey, I'm tired of talking about business. Let's not talk about business. Okay, then you made a choice to make it non-deductible. At least it's your choice. It's not just because you don't know, right? Ignorance does not help when it comes to taxes. Ignorance is the biggest hindrance to taxes. So what about travel? Well, travel is interesting. If you're traveling within the United States, then all you have to do is make sure that more than half a day, every day that you're traveling, is in business. And if it is, that means that the primary purpose was business, and it means that 100% of your travel is deductible. Now, it doesn't make your spouse's travel deductible, doesn't make your kids' travel deductible. It makes your travel deductible. So do you want to spend 4.5 hours a day? Well, you go, well, I'm going to be on my computer anyway, 4.5 hours a day, so I'm going to count that. No, because you didn't travel so that you could use your computer. You could have done that at home. There has to be a business reason. The primary reason for traveling was business. So you might be meeting with potential clients. You might be meeting with business colleagues. You might be, if you're in real estate, looking for real estate. You can absolutely create that business purpose if you want to. Now, for me, there's 2 weeks a year. I don't want to do business. I'm on vacation. I want that vacation. I need that vacation. I have to have that vacation. I do not do business during that 2 weeks. I choose for it not to be deductible. I have a choice because I know that if I were to spend the time. Now, by the way, in domestic travel, within the 48 states. And in domestic travel, it's an all or nothing. But when you're traveling international, it's proportionate, which means that if I spend 2 days out of 5 of my travel doing business, then 2 out of 5 or 40% is deductible. All right. So there's a difference for international than there is domestic. Domestic is all or nothing. International is proportionate. So just keep that in mind. Now, what about your family? This is number 7. And I mean, these are a lot of tips. Let me tell you, it's a lot in one video. But what about your family? I find your family is one of the greatest opportunities to create deductions for money you would otherwise spend anyway, okay? And get a deduction for it. How do you do this? Well, let's say you take your kids and you put them to work in your business and you pay your kids. Did you know that in 2025, the first $15,750 that you pay to your kids is not taxable to them? They have a 0 tax rate for that because they get a standard deduction for earned income. They don't get a standard deduction for investment income. That one's a lot lower. But for earned income, they get the full standard deduction. So think about paying them $15,000. Go back to that 20% tax bracket. Now you're talking about $3,000 to put in your pocket. Well, but wait a minute, what are you gonna do with that $15,000? You're not just gonna hand them $15,000. Well, a couple of things that have to happen. First of all, they actually have to do the work and they have to be worth $15,000. Okay, so if they do work worth $3,000, then you pay them $3,000. Again, you may not want that going in their pocket. Where does it go? There are a couple of options. One is it can, of course, go into a bank account, a savings account for them. I'll tell you in a later video why I think that's a bad idea, but it could go into a savings account for them. They could actually put it into a 401k or an IRA, right? They could actually put it into another plan, like a Roth IRA. Well, I mean, what a great idea. Put it into a Roth IRA. They didn't pay tax on it, so it doesn't matter. They didn't get a deduction and it grows tax-free for the rest of their life. Put it into a Roth IRA. But what else could you do? Well, what if you were a real estate investor? Couldn't you invest in your real estate through a family limited partnership? Sure you could. Could they invest in that partnership? Of course they could. Now, there are limitations on what minority children can do. So make sure you talk to your advisors about how to structure this properly, because contract you enter into with minority is voidable. So frequently you need to use a trust, or you might have to use a particular type of bank account for your child, okay, that you're the custodian of. So there's some make sure you follow the details. Remember, in taxes, it really comes down to the details. You must dot your I's, you must cross your T's, else I guarantee you, when the IRS comes knocking, you will not get that deduction. And you do need to justify that they are actually working. Now, why would Congress do that? They actually have a pretty good incentive for it, and I'm a good example of this. Okay, I grew up in a family business. I started working at my dad's business when I was 12, and I worked all the way through high school. Well, in high school, I worked in the accounting department. I am now a professional accountant. So that doesn't always happen. My brother worked in the press room. It was a print shop. And in the press room, he learned all sorts of things, but here's what he did, is he understood what was going on in the business. Now, we got paid for it. Now, in that case, we got paid. My parents didn't believe in giving us an allowance, okay? We had to work. So this was the way we earned our money, but they provided the job for us. It's good for children to learn how to work. It's good children to learn how to work in the family business. There's all sorts of good things about children working in a family business. And it's good for the parents, it's good for the business, and it's good for the children. So there is good public policy behind this particular provision of the tax law. Now, interestingly enough, this is the case all over the world. I was in South Africa a number of years ago, and I had a South African tax advisor on stage with me. And I presented this idea to the audience, and I turned to her, and she was a really good tax advisor. And I said, so what do you think? Could you do that in South Africa? She looks at me, she goes, well, yeah, we could do that. It's like she hadn't thought of it. And that's fair enough. I'm telling you things that a lot of accountants don't know. So just make sure you take advantage of that. Now, you want to make all these deductions audit proof, because the IRS is a little dubious, you can imagine, of personal expenses that you've turned into business expenses. Well, what's the key here? The key here is documentation, documentation, documentation. Just remember that there are 4 rules for a deduction to be qualified as a business deduction. First is, there must be a business purpose to it. Second of all, it must be ordinary, meaning typical in your business. Third, it must be profitable. The intent must be to create a profit for you. So, and fourth, it must be properly documented. Who, what, when, where, and why. Now think about that. If you never spent money that wasn't profitable, documented, have a business purpose, and ordinary in your course of business, wouldn't you make more money? I think so. So see, the tax law is not just a roadmap for reducing taxes. It's actually the best roadmap ever created for building massive amounts of wealth. So keep your receipts, document who, what, when, where, and why. Put your effort towards these deductions, and just remember, everything that you spend could be deductible. Become a super taxpayer. Do it like the wealthy. I'm not saying to cheat. I want to be really clear. None of this is cheating. We're not cutting any corners here. We're doing exactly what the IRS and Congress wants us to do. So what are we doing is we're planning every single day. If you look at my book, Tax Free Wealth, you'll see some little things I do. For example, I have a credit card in my business. I like to pay with a credit card from the business. What does that mean? I don't have to get reimbursed by the business. You know, there's a lot of things I don't have to do. It just makes it easier, but I have to be careful. I can only use that business credit card for business. So when you start a business, even a small one, just remember, you're unlocking an entire side of the tax law that's written specifically for entrepreneurs and investors. So take a look at this example, the side-by-side example in this chart here of what happens between an employee and a small business owner with these different expenses. Just remember, when you change your facts, you can change your tax. If you want to see how to even deduct your family vacation, watch this video.